This video is an Uncovered Japan company research report on VIS Co. Limited, ticker 5071. VIS is an Osaka-based office design specialist. It helps companies diagnose workplace needs, design and deliver a finished office, then measure the outcome. The core business earns margins far above its peer group. The research question is whether that quality, cash-rich franchise can turn its newer platform and flexible office bets into the next stage of growth. At the report's June 2026 reference date, VIS traded on a forward price-to-earnings ratio of 9.3 times, with an 11.8% FY26 operating margin and a 4.31% dividend yield. It held 6.6 billion yen of cash, no interest-bearing debt, and had generated free cash flow above 0.8 billion yen in each of the preceding 5 years. The trade-off is near-term. FY27 guidance points to only roughly flat operating profit as VIS spends on people, flexible offices, and its workplace platform. VIS is not simply a contractor that fills an office with furniture. Its work design approach begins with the Work Design Platform, or WDP, to identify organizational and employee engagement issues. VIS then designs the space and manages delivery, while construction itself is handled through partners. A follow-up survey is meant to demonstrate the result, keeping consulting, design, and after-survey work in-house, while outsourcing construction lets VIS focus its own people on the higher-value parts of the project. The 5-year financial record is the first reason VIS deserves attention. Revenue rose from 10.7 billion yen in FY22 to 16.5 billion yen in FY26, an 11.3% compound annual growth rate. Operating profit grew faster, from 1.01 billion to 1.94 billion yen, or 17.8% annually. That widening is evidence that the company has not merely won more projects, it has increased the value it captures from them. The segment chart makes the business model clear. Branding accounted for 96.4% of sales and delivered a 12.6% operating margin. It includes office, web, and corporate identity design. Data and place solutions was only 3.6% of sales. It includes WDP, the Kokowell organizational survey tool, and the Place Flexible Office Network. That smaller segment declined in FY26 as VIS absorbed Shimbashi opening costs and platform spending. VIS's advantage is a higher value project model rather than a claim that office design is immune to competition. The WDP survey gives it a consulting-led entry point. It has deliberately concentrated on larger projects. The number of projects above 100 million yen rose from 5 in FY19 to 34 in FY25. Average project value rose 32% from FY23 to FY25. Awards, office tours, and regional relationships then help establish the trust needed for enterprise mandates. Capital returns are one of the clearer positives. VIS has raised its dividend for 5 straight years and plans to lift the payout ratio from 30% toward 40%. The report's 4.31% yield was near the top of its peer set. But the report also identifies a conspicuous omission. VIS has never bought back shares, even with 6.6 billion yen of cash. A buyback and cancellation would be the clearest potential catalyst, but it is not a commitment. The FY27 outlook is why this is not a simple momentum story. VIS guides operating profit at about 1.95 billion yen, effectively flat, while net income is projected to fall 9.5%. Management is putting resources into headcount, WDP, and flexible office capacity. The constructive case is that this is a deliberate investment pause, consistent with management's history of conservative guidance. The risk case is that a project-based office business is entering a slower demand environment. Both interpretations need monitoring. VIS has set a Vision 2030 goal of 25 billion yen in revenue and 2.5 billion yen in operating profit, up from 16.5 billion and 1.94 billion respectively in fiscal year 26. The plan depends on 2 levers that are not proven yet. First, VIS must improve win rates and recruit enough senior creative talent. Second, WDP and the Place need to scale from a small strategic investment into a real second pillar. Management also names planned M&A, but has no acquisition track record. Valuation is not heroic in the report. VIS's 9.3 times forward earnings multiple sits around its own multi-year average of roughly 9.9 times. More notably, it has the highest operating margin in its listed peer set, at 11.8%, yet trades below the roughly 11 times peer average forward multiple. The market may be pricing the small float, thin liquidity, and near-term earnings plateau more than the business quality. The report's 3-year scenario framework ranges from 1,100 yen in the bear case to 1,800 yen in the base case and 2,400 yen in the bull case, versus a 1,370 yen reference price. These are author estimates, not price targets. The range depends on plan execution, margin durability, and capital allocation. It is also affected by a difficult market structure issue. The report recorded an extreme margin buying overhang, which can cap upside or make the path to any re-rating choppy. VIS combines a differentiated workplace design model, unusually high margins, a debt-free balance sheet, and a growing dividend. The opportunity is that its platform, flexible office, and capital allocation choices could make the business more scalable and more highly valued. The risks are equally visible: an investment year earnings plateau, cyclicality in office spending, a tiny second segment that must prove itself, scarce creative talent, and thin small cap liquidity. The useful next step is to watch the scorecard, not to treat this research as investment advice. For a much deeper look, visit the free deep dives at uncoverjapan.com. We go beyond the headline numbers to cover the business, financials, valuation, risks, and catalysts. This video is for information and education only. It is not investment advice or a recommendation to buy or sell any security. Always do your own research.